Hey everyone, Chris Funk here with Southern Impression Homes. Recently, I've been getting a lot of phone calls about the wildly changing interest rates that we're seeing out in the market today. And the question I'm getting from a lot of our clients is, "Hey, these rates are going up pretty rapidly. Are you seeing any other finance product out there that's more attractive?" And the short answer is yes. And I'm going to get into that in a few moments. But I'm going to take a minute to look at this chart and give you my thoughts on what I think is happening with interest rates and where I think they're going. If you go back to 1981, a little over 40 years ago, you can see the rates were as high as 18.5%. And we've been on a steady downward trend since that point in time. Peaks and valleys along the way, but still steadily downward trending all the way until today. So we're up to a little over 5% today. I do think that they are ultimately going to come back down some. I think the Fed has really spiked the rates, and I do anticipate that sometime over the next couple of years that we'll start to that we'll see the rates slack off and become a little bit lower. But in the meantime, we've still got some pretty significant inflation that we're trying to protect against. So as real estate investors, we're trying to take advantage of what might happen with inflation, with increasing prices, but we're also trying to hedge against a downside and give ourselves as much cash flow as possible in the event of a downside. And today we're seeing some really great ARMs, adjustable rate mortgages. And I'm going to explain what these are here, at least some product that I'm using personally and that we can help introduce you to as one of our clients. So the first thing is, what does ARM mean? ARM means adjustable rate mortgage. The product that we're going to be talking about today that I really like is what's called a 5/1 ARM. And this particular product is actually a 30-year term. So it gives you a 30-year loan. So you don't have to pay off the loan for 30 years. But the first 5 years are interest only, and the rate is locked for those first 5 years. So what does the interest only do? Well, it just gives you a lot more cash flow for your product because it's not amortizing. Okay, so you're not paying any principal down during that 5-year period, which increases the cash flow of your property. It also buys you time for rents to go up. So that's really what these interest only time periods are for. Is we've all seen the rapid rent growth over the last couple of years. We continue to see rent growth, but an interest only loan allows time for that rent growth to catch up before your loan amortizes. So this would be a 30-year term. First 5 years are interest only, and then the next 25 are amortizing. So fully amortized over the next 25 years. All right. So 5/1 ARM with an interest only period. What does the 5 mean? The 5 is the number of years that the rate is fixed and the number of years that the loan will be interest only. The 1 is how often does the rate adjust. In the case of this loan, the rate would adjust once every year, or could adjust once every year. As of today, June 4th, 2022, we're seeing 5/1 ARMs with interest rates between 5.25 and 5.75%. Oftentimes when you're talking to lenders, they're going to talk about the caps. The caps refer to the limits that the interest rate can increase or decrease during the term of the loan. I think a common misconception is that an adjustable rate mortgage can adjust at any time. That's not the case. There's caps in place to protect you from it adjusting too much, and it can only happen a certain number of times. So like we talked about in the previous slide, can only happen once per year. So 5/1 ARM with 225 caps. The first 2 is the maximum amount that the interest rate can go up or down at the end of the 5-year fixed rate period. So in your 6th year of the loan, your rate can adjust no more than 2%, and that's up or down. So if you're at a 5.25% interest rate, it could go up as much as up to 7.25 or down as low as 3.25. The second 2 in the 225 cap is the maximum amount that the interest rate can go up or down in any given adjustment period. In the case of the 5/1 ARM, the adjustment period is once per year at the end of the initial 5-year period. So there's a differentiation, between the first 2% and the second 2%. They happen to be the same in this scenario, that they can go up or down by 2% in the 6th year or any year thereafter, but that's not always the case. Sometimes the first number is different than the second number. Now the last number, the 5, is probably the most important number. And the 5 is the maximum amount that the interest rate can increase or decrease during the entire 30-year term of the loan. So the rate can adjust annually, can go up or down by 2% annually, but it can never go up or down by more than 5%. It could go as low as 0.25, but it could go as high as 10.25. So again, the goal here with the adjustable rate mortgages with the 5-year interest only period is to hedge against any eventuality. And remember, in all these scenarios, the other thing that's fluctuating is your rent amount. I'll show you some slides at the end about how rents changed and how rents changed during the last recession. But to give you a quick sneak peek, during the last recession, rents did not go down at all. They actually increased during the recession and created more rental income for the owner of the property during that recessionary time period. So if you happen to hit a recessionary time period and your rents continue to go up, which would be likely in today's scenario because supply is so restricted, but interest rates go down, you can take advantage and refinance that loan at that point in time. However, if interest rates continue to skyrocket and they go through the roof, well, that probably means that rents are going to continue to go through the roof as well, and you'll be able to support that higher interest rate, but it'll be capped at a certain number, which could be significantly lower than what the maximum interest rate could go to if you were to have to go get a new loan. So the fact that these are truly 30-year loans that start amortizing in that 6th year, really takes a lot of the risk off the table for you as a borrower. One of the things that lenders like to put in these adjustable rate mortgages, and really all commercial loans, is a prepayment penalty. So with the 5-1 ARM that we're talking about today, we've seen that the prepayment penalty on this product is a 3-2-1 prepayment penalty. So the 3 means that you will pay a penalty equal to 3% of the loan amount if you pay off the loan in the first year of the term. So if you get the loan and then all of a sudden rates drop down to 2% and you say, hey, I want to refinance, you probably should refinance. However, you're going to pay 3% of your loan balance to the bank as a penalty for exiting the loan so fast. The 2 means that you'll pay a penalty of 2% of the loan if you pay off the loan in the second year. And the 1 means that you'll pay a penalty equal to 1% of the loan if you pay off the loan in the third year of the term. After that third year, there is no prepayment penalty. Now, every commercial loan has its own prepayment penalty, but in the one that we're discussing today, after year 3, there's no prepayment penalty. So balloon payment, as I mentioned earlier, the loan that we're talking about today has a true 30-year term, meaning that there is no balloon payment. However, some of these adjustable rate mortgages have a balloon payment, whereas at the end of the term, you might have to pay off the full loan. Now, that's not the end of the world. I have plenty of balloon payment mortgages in my portfolio. It's not a terrible thing, but just understand that that is a risk out there that you may have to pay off the mortgage. Whereas, with one of these adjustable rate loans that is interest only for a period and then amortizing for a period, you never have to worry about paying off the loan in a bulk payment. Most of your commercial lenders are going to look for DSCR. So they always throw out this DSCR term. That stands for debt service coverage ratio. In commercial loans, they look more at the property, the asset, and the income being produced through that property and that asset than they do at the borrower and the borrower's income. And, so it's really important to know how to calculate your DSCR. So to do that, you take your net operating income annually, so your annual net operating income, and you divide it by what your annual debt payment would be. So you're taking your net operating income before your debt payment and dividing that number by your annual debt payment. Most lenders want to see a 1 to a 1.2 debt service coverage ratio. That means that the property is cash flowing enough to at least pay the mortgage. And anything above a 1 means that it's kicking off cash flow in addition to the mortgage being paid. One of the great aspects of commercial loans is that you can get non-recourse on these loans. So the loan that we're talking about today that I'm utilizing is a non-recourse loan. And what that means is it limits your risk as the borrower to the bank. So if let's say you buy a duplex and the purchase price of that duplex is $500,000 and you've got to put 20% down. So you're putting $100,000 down. With a non-recourse loan, if there was ever a reason that you were not able to make the payments on that loan and the bank had to take that property back, you would of course lose the $100,000 in equity that you put into the property, but you would not be responsible personally to the bank for the remaining $400,000. In the case of this commercial loan, non-recourse limits your liability to only the amount of money that you put in that property up front. So let's say that the inflation continues to run rampant and next year inflation goes up another 10%. Well, you own a $500,000 asset, the bank put in $400,000, you put in $100,000, and that $500,000 asset went up 10% in value. So it went up to $550,000. Well, you only had $100,000 in. You just made a 50% return on your $100,000 in that time period. You made 50% return, but the bank, they still just are owed the same amount of money that they were owed. Even though inflation has been running rampant, you only have to pay them back the $400,000. The loan amount isn't inflating with the value of the property. So now let's take the flip side of that. Let's say that the economy totally crashed. You're only out the money. If you ended up giving the property back to the bank, you're only out the money that you put in the property up front. You don't have to come out of pocket. But the bank is now left with that asset, and they're trying to figure out how to recoup their remaining $400,000. Last but not least, in both commercial and residential mortgages, you see lenders offering interest rate locks. These are extremely helpful, particularly in time periods where rates are fluctuating so drastically like they are today. Sometimes they charge for these locks, sometimes they don't, but it's always worth asking if there's an interest rate option and what the cost of that option is. We're going to talk about how ARMs versus fully amortizing fixed rate mortgages affect the cash flow of your property. So I've got two of our Ocala properties up here on the screen, and you can see that both of these have a 5% or 5.5% interest rate. We're seeing 5.25 to 5.75 interest only loans for adjustable rate mortgages, and we're seeing 5.5% rates on the 30-year fixed mortgages right now. Okay, so each one of these you can see 5.5%. This one's interest only. This one's amortizing and fixed for 30 years. This one's a 30-year term, 5 years interest only during that time period. But let's look at the cash flow of these properties, because that's the only thing that's different. You can see the rents are exactly the same. The expenses are exactly the same. The only difference is the financing structure. So you can see here in the 30-year fixed mortgage, the cash flow is $79 a month or $946 a year. Well, here we've got the same interest rate, but we're not paying any principal down on the adjustable rate mortgage. So our cash flow went up from $79 a month to $313 a month, totaling $3,700 a year versus $946 a year. So major differences in the cash flow, and you can see this over here in the cash on cash returns with your tax savings. So you go up from 5.4 to 8.6, and your IRR goes up. You say, well, hey, why does my IRR go up? Don't I get the principal back that I paid down when I sell the property? You're absolutely right, you do, but you didn't get it until later. So that the fact that you got your cash flow earlier makes your IRR in an interest-only loan much higher than your IRR in a 30-year fixed, because you were having to pay that principal down. The other cool thing is you look at the debt coverage ratio. So here, because the cash flow is lower, your debt coverage ratio on a 30-year fixed is only 1.06. That's still within lendable rates, so it's above 1, which is what the lenders want to see. But for you as an investor, being at a 1.32, where you're able to take more cash flow off of the table, so you're able to create cash flow for yourself above and beyond what you have to pay for the bank, it's extremely attractive. So what I'm going to do is I'm going to go back over to our 30-year fixed, and I'm going to make an adjustment. I'm going to say, okay, let's say rates go back down to 3.5%. Right, so your cash flow on your adjustable rate mortgage, on your fixed rate mortgage now increases to be almost identical to your adjustable rate mortgage. So if you can see right here, your cash flow went up to $333 a month, so $4,000 a year, which is almost identical to your adjustable rate mortgage interest only, which is $313 a month, $3,700 a year. Now, the other cool thing that I touched on earlier is the fact that the adjustable rate mortgages allow you to really take advantage of your rent growth that you're seeing. So get cash flow now while rents are growing, because the beauty of real estate is you're locking in at a fixed basis. And the way that prices are going up right now, that price goes up every single day. So your basis isn't going to change in that property, but your rent is going to change. So, let's assume that, we go back to the 5.5%. So let's say that the rates don't change. The fixed rate mortgage stays at 5.5% here for the next 5 years. And we go back to this $79 cash flow for the fixed rate mortgage. Well, if you were in this adjustable rate mortgage for 5 years, and these the interest rates didn't change at all, your rents probably did change. Your rents have probably gone up, and your rents have probably gone up by a lot. So you take this particular product right here, over the last 5 years, the rental rate for this particular home has gone up by $500. So if I go back over here and I increase our rental rate for this property from $17.45 and I take it up to $22.45, my cash flow now exceeds the cash flow of the fixed or of the adjustable rate mortgage. So again, this is another variable that you have to take into account when you're deciding when, if ever, you want to switch into a fully amortized 30-year fixed loan. Now, let's take it one step further. Let's say, the rents continue to go up here for several years, but then we hit a recession. So to investors that are buying homes today, that could be really your best case scenario. You have inflation and rents go up here for 5 more years, and we hit $22.45 in rents. But then all of a sudden, a recession hits and rates go back down to 3.5%. Your cash flow goes up to $774 a month, almost a little over $9,000 a year. So remember, you started here with an adjustable rate mortgage, an interest only loan at $3,700 a year. Now all of a sudden, just with rent growth and interest rates coming back down in line, you're almost three times the cash flow on that same property. So one more thing I want to show you. This here is the index for the rental rates for whatever the last 70 years. Beginning of 2007, rental rates had an index. So this is index. It's not giving you an exact rate. The index was 230 during that recession. So you can see, and the rents continued to increase even as we were entering a recession. Rents continued to go up, 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 up. Well, you can see right here, rents flattened off. So in 2009, from 2009 through 2010, rents were flat, and then they took off again. Well, there's a couple things going on here. What you don't know is during 2009, that was the height of inventory on the market in the United States, both rental inventory and for sale inventory. So there was a glut of housing on the market. But what we're not seeing today is a glut of housing. We're actually seeing a sharp decrease in housing supply, which is what's driving rent and home prices up so much. If we had a supply glut, if we were oversupplied in 2009 and we saw rents just flatten out for only 2 years, and then they continue to rise thereafter, what does it say in a recessionary period where we're being driven into a recession by the Fed driving interest rates up, but housing supply is still tight? Well, it tells me that, since we saw the rental rates continue to climb here and then flatten out, I don't think we'll see a flattening in a recessionary period right now because we have such a little amount of housing supply. There's nothing putting pressure on rents to move them in a downward direction. Only one more thing to talk about, which is what happens at the end of the 5-year term if the rate goes up to that cap. So remember, we talked about that 2% cap at the end of the 5-year term. So let's say you rolled into the amortizing portion of this 5/1 ARM. What does that look like from a cash flow perspective? So as you can see here, we left off at the 3.5%, but let's assume now that this goes to 7.25%. So I'm going to change our interest rate to 7.25. Now remember, this now amortizes. So you'll see I've opened up the amortization table over here. And remember, it's amortizing over 25 years because the first 5 years was interest only, but it's a 30-year loan. So we're going to amortize across 25 years now. So that's going to be 12 times 25. So we're going to change that from 360 to 300. So here we are. So if you recall, 5 years has gone by. We assumed that the rents went up to this 2245. And we now switch this from a 30-year amortizing to a 25-year amortizing loan. And we increased the interest rate to 7.25. So remember, the loan rate was 5.25 plus we had a 2% cap, and we're assuming that the interest rates went up. And now let's look at cash flow. So you can see your cash flow now is at $189 a month, so $2,200 a year. So we were at $774 a month, almost a little over $9,000 a year, and that was in the instance of us being able to refinance out of this 5/1 ARM and into a lower interest rate loan. And now with a fully amortizing, with the 5/1 AM going to fully amortizing, that cash flow drops from $9,200 to $2,200 a year. But you can see, as the rents go up over time, you're really hedging your risk on the interest rate going up. The chances are, if the interest rate continued to be this high, it could have actually gone higher than this 7.25, and the rents may have actually increased at a faster pace if the interest rates continue to go up, because that means that we did not get a handle on inflation. So I hope this helps give you all sides of the coin here. What happens if you use a 5/1 ARM versus a 30-year fixed?